Today on the Startup REI show, we actually have a guest, and his name is Paul Shannon. I'll bring him in right now. What's up, Paul? How you doing, man?
Yvonne, good to be here. Thanks for having me today.
Thank you for being here. I wanted to bring you on because I know you're an expert in multifamily. You do commercial multifamily. You are also an LP, and just at your core, not only are you an entrepreneur, but you're also a real estate investor. Can you talk a little bit more about your background, maybe how you got started?
Yeah, absolutely. My background is in medical device sales, capital equipment. I used to call on surgeons in the operating room,
Uh-huh.
implementing the equipment that's used to replace or operate for cataract surgery. So I did that for a number of years. Was in different sales roles prior to that. But ultimately, real estate investing was attractive to me as a potential supplement to my income at the time.
Right.
And then as I kind of evolved in the business and got more understanding of, you know, from the single family space into the multifamily space, I saw it as a scalable operation. So
Correct.
about 3 years ago, I left the W-2 world and ventured out on my own as an entrepreneur. So I've been doing it ever since.
Three years ago. Wow. Was that at all hard? I presume that was a hard transition initially because then you're like, oh wait, where am I gonna get cash flow, right?
Yeah, I mean, initially it is difficult because you kind of have the bird in the hand. For me, it was always trying to get into the next role in my corporate career and had some success with upward mobility. And so you see that and you look back at all the time you've put in and the track record you've built and the sort of personal capital that you've built with your relationships with people in the business. And to leave all that behind and kind of start fresh certainly is nerve wracking. And then obviously you've got an income adjustment to kind of learn to deal with at
Correct.
first.
Correct. Correct.
But I, had kind of taken the slow road. I had done some, obviously some initial due diligence on the whole industry. I'd read a lot of
Mm-hmm.
books, listened to a lot of podcasts, got into the space in a duplex, did a couple of pretty heavy single family lifts and
Yeah.
refinanced those and got all my capital out. So I kind of saw that, hey, this is a scalable business, got the proof of concept down, started to believe in myself and got a little more confidence. So it wasn't like I was going in at ground zero. I kind of built up at least a little bit of a track record and knew that all I really need to do to scale this to the next level is just dedicate more time to it. Time was something I didn't have, but when I
Yeah.
left my W-2 job, I could fully devote myself 100% to real estate. So
Wow. Wow. That's really the startup experience there. And just to give you a heads up here, most of the audience is coming from a background of the startup realm. So it's either they're startup founders, angel investors, or VCs that want to learn more about how this cash flow game works. Not necessarily a game, but essentially it is a financial one at least. And coming from the IPO themselves, and myself coming from founding one before, I realized that cash flow was always a problem, and having that foundational thing was a very important thing instead of just relying on an exit later on for IPO or like exit that way. But out of all that, you're also human, right? And so, at the deepest core, outside of all these titles that we just mentioned earlier, as a human being, why do you do what you do?
that's a great question. I mean, first and foremost, it's for my family. When I was in my corporate career, I was traveling about 80 nights a year. I was working close to
Wow.
80 hours a week. I was gone typically before my kids were even out of bed. Sometimes, obviously, with travel, I wouldn't see them for days at a time. So, I mean, at the core, the decision was based around my values not aligning with where I was spending my time. So
Correct. Correct.
now I have time freedom. I can work around my personal life and kind of mold my career or my real estate business around the other goals that are more important to me, like family, health, et cetera, et cetera. So that's the biggest thing. And then also from a giving back standpoint, I think real estate is a great business because let's face it, I mean, a lot of properties end up with some wear and tear. They start to get
Yeah.
distressed. They don't have the capital infusion they need to keep up with maintenance, et cetera, et cetera. So my business model has kind of been where profit and progress meet. You can't have one without the other. So if
Yeah.
you can bring investment dollars into a community and make the community a better place to live for the residents, but also provide a return for investors, that's where profit and progress meet. So I'd say for
Understood.
those two
Understood.
reasons, real estate made a lot of sense for me.
Understood. Okay. But when was the turning point as to when you found out that that was like a what I guess the real question here is, can you talk a little bit more about like the defining moment for that particular value or moral.
Yeah. Well, there are like examples of how that kind of philosophy came to fruition. I would say there were two kind of moments where I realized that this was the path I needed to be on. Number one was actually having success in the business, and it started with a small win, really, to get that kind of confidence. I had purchased a single family home at auction. It was in need of significant upgrades down to the studs, plumbing, everything, electric. I took that property from an ugly duck and made it into something really nice, filled it with renters, was able to refinance all the initial capital that I had put in, including getting paid, what I call getting paid an additional lump of money that was on top of the capital that I invested. So that was really kind of like the moment where a light bulb went off that, hey, this is a business where I can take my money, I can consistently sort of recycle it, if you will, and continue to have a compound to grow my business. And then from more of a personal standpoint on the W-2 work, on the corporate side of things, I just stopped really admiring the leadership team that I was working with. At first it was sort of exciting to get into that next role, and you look at who your managements were, or your management team was, or who was in positions that you might want to kind of gravitate towards and work towards getting into that role eventually in your career. And that was the case for me for about 15 years. And then at a certain point, I realized that I didn't admire these folks anymore from a personal life standpoint. Like they were just sacrificing so much time. And again, my values weren't aligning that way. So I felt like I needed to go out on my own and kind of create my own life.
That is, thank you for that authentic story, man. And something I want to ask you just to deep dive into that is scalability, literally from going medical sales to cash flow in real estate. What was probably most important to people that are listening in and tuning in is, can you talk about numbers? If you can go that route. I don't know. It's probably too personal here, but how much are you making? Where are you making? And then how much are you making now? And what's that looking on going forward?
Well, it's very variable now as an entrepreneur. It's not necessarily like a consistent paycheck. So when I had left my W-2 work, I was making between 250 to 300. So it was really, pretty comfortable salary and bonus and everything combined. Led to a pretty, comfortable lifestyle. But where I was spending my time, I really didn't have time to enjoy that. So with real estate, it's different. There's the cash flow component of it, but really, with real estate, the big upside is on the appreciation. Or on the refinance as well. You can actually do cash out refinances, not have a taxable event, and then take that money and then reinvest it and have the cash flow kind of compound. So from a real estate standpoint, things have changed a little bit. And, there's been some years where I've sold some things, and then there's been years where I haven't sold anything. So the cash flow is essentially enough to live off of. And then the appreciation is kind of that upside moving forward. So some great years. And, the thing with real estate is that if you look at what you're making, you have to combine some sort of intangible things like the tax benefits, for example. If you do a cost segregation study and you're able to write off not only the passive income that the property produces, but the active income that you make or even your spouse makes because you're a real estate professional, those are intangibles that don't show up on any tax forms. But I should say they do show up on tax forms, but they don't show up as far as a paycheck is concerned. And it's really not necessarily about how much you're making, but how much you're keeping. And that's what's great about real estate is that you can have some kind of creative ways to construct your wealth that are not available to W-2 workers.
I'm so excited about this because I know you are the principal and owner of Red Hawk, and I want you to pitch to people that's on here why your solution or your opportunity is not necessarily better, but the best, and what's most unique about your company. Because these people really want to put in money into your deals and really just trying to learn more, right?
Sure. Well, we really cater to the fixed income investor. We've noticed that bonds have become less and less attractive over time because interest rates have continually fallen over the last 40 years. And that's worked out well in the traditional sense of a 60-40 stock bond portfolio that financial advisors often tout. But if you look at that 40% of bonds and where things stand today, the 10-year treasury is about 2%. Okay. And it's been fluctuating. It's been lower than that over the last couple of years. It hasn't been much higher. But what's interesting is that inflation is about 7.5% today. So with the 10-year paying 2% and pretty much bonds, whether they're corporate bonds, muni bonds, government bonds, they're all sort of around that 2% to 4%, maybe if you're lucky. That's going to be tough to find or less. um, you're looking at a negative real yield there when you factor in that 7% inflation. If it's 2% for the 10-year Treasury and inflation's at 7.5%, you're losing essentially. You're locking in a 5.5% loss on new issue bonds today.
Correct.
So that's not a very good prospect. And then if you think about what's going on with the Federal Reserve and the talk around raising the Fed funds rate and what's that going to do to interest rates? Well, if interest rates rise, the value of those bonds is going to drop even more because they're inversely related. So what used to work as far as the 60-40 portfolio no longer does. So we feel as though real estate is a strong play as far as the ability to replace that 40% of the bond portfolio for a few reasons. And real estate can act a lot like a bond. It provides capital preservation. It provides a hedge against an economic slowdown. It pays income. And it also allows for the opportunity of appreciation. If it's done correctly, it can be a phenomenal way to balance out your equity positions with real estate and have the portfolio kind of be an all-weather type portfolio. So we look for properties that have a lot of margin of safety. We rely heavily on some of the metrics that are not as widely known by some of the other people in the business. A lot of people really advertise IRR or equity multiple or cash on cash return. And we think those things are important. We certainly want to buy assets that are cash flowing day one, but we really look closely at yield on cost. And what yield on cost takes into account is the pro forma NOI. So when we buy the property, we're not really too concerned about what the cap rate is. We want to know when we execute our value add plan, what is property going to be operating at? What is the pro forma or stabilized net operating income when we're finished with our value add plan, divided by our total project cost, not just what we paid for the property, but what we put into it from a CapEx standpoint. So for an example, let's say you buy a property at a 3 cap in a 5 cap market. So you're buying at a higher cap, or excuse me, a lower cap rate, which would be a higher valuation based on actuals than you would expect, but you're paying that seller a premium for the opportunity to essentially execute your value add plan. So buy at a 3, market's at a 5. I want to know that when we're finished executing our value add plan, I can operate it, for example, at a 7. And that spread between the market cap rate and the 7 cap is a 200 basis point spread. That's your lift. Essentially, that's your spread. And that's the value you're bringing to the property. So we know when we do that successfully, we've created a lot of value in the property. And we also know that we have a lot of margin of safety if, in the event that interest rates do rise and cap rates decompress, we still created enough value that we can basically have a safe asset that we can hold for the long term that's still going to cash flow. So very conservative. You hear conservative underwriting a lot in this business, but I'm not sure how often that actually is true. And in our case, we really want a lot of margin of safety. So we pass on most deals we see.
I'm trying to understand and grasp that more, because most of the time, it's all about IRR and cash on cash for investors, right? And as an operator and fund manager myself, I know you are too, we're always trying to figure out how do we protect the downside for our investors, not only considering inflation being like, we're in like a different circumstance with the market now, but like, how do you, can you talk a little bit more about how that works? I'm not really understanding, because if I'm not understanding it, I can't explain it to someone else. If I can't teach someone else, then I really don't understand it. So how are you protecting the downside again for that specific strategy? Because
as it relates to the yield on cost metric specifically?
Yes, because to me, it just sounds like it's based off of the pro forma and not the actuals. I'm an actuals underwriter. That's why it's like, this is it for me. How is that conservative, right? That's
sure. If you're buying stabilized assets, I think that your philosophy is probably the right way to go, because you don't have that much ability to force appreciation through any value add plan. What we're doing is we're buying distressed assets that are a deeper value
that
add.
Makes more sense.
Yeah. So we're going to have to inject capital into the deal to make it more of a stabilized property. And in doing so, we're able to get that yield on cost above the market cap rate. And that spread between the market cap rate and yield on cost is really where it enables us to look at and say, okay, we're likely in a scenario where we're going to be really successful if we go ahead and sell this property, or if we want to refinance, we'll be able to get some or a lot of our capital back out.
That makes sense.
But when you talk about margin of safety and how we look at things and how we protect the downside, I think one of the bigger elements of that is sourcing of debt. When you think about the lender potentially bringing 80% of the capital of the deal, that's a huge amount of money proportionate to the deal. And debt terms are very important. So today, in today's market, you see a lot of people using bridge.
Bridge.
And in some cases, you have to use bridge, but not always. And what's interesting is that you have to look at where things are going to be going if you're going to use bridge, because you've got a floating rate.
You do.
You've got to consider a couple different things. When that loan matures, is there going to be a buyer prior to that?
Yep.
Or if it does, are you going to have a takeout loan that is able to refinance into? So, understanding where interest rates are is absolutely paramount in this business, and just underwriting to scenarios that may not actually come true, but you kind of want to test your model. You want to push it to the limits and see where it breaks down. And then you kind of back into, okay, well, how realistic is that situation? What would have to happen in the marketplace for this scenario to come true? And if it's more than likely impossible to happen, well, then you know that you can kind of like back off of those like sort of doomsday assumptions.
Yeah.
But sourcing of debt and being conservative with the debt you use and making sure the debt matches your business plan is paramount.
Yeah. That's right. So deep value add is what you're doing. That's from my understanding. Are those C class, B class? I mean,
they're C class. So we're in Indianapolis.
C class. Okay.
Yeah, we're in Indianapolis, and we look in Evansville, Indiana. We don't have assets in Ohio, but we're looking in that area as well. And that has historically been kind of our niche, is these like mid-sized multifamily properties that have been built, in the mid 1900s. That
mid-size is how many units? I'm sorry.
Like 40 units, right around that
plus
range.
Okay.
Yeah. So it's usually these are properties that have some sort of distress component, whether it's owner that was undercapitalized, that has been holding onto the asset for way too long and has kind of let some maintenance issues go for a little too long. So we run into that sometimes, and those are opportunities though. So that's a situation where you can go in, and if you can bring the right amount of equity to the deal, you can take care of a lot of those issues. And for us, it's been beneficial to look at these types of properties because they're under the radar of a lot of syndicators who are looking for 100+ unit properties. And for good reason, they're kind of ignoring these deals because you have to have boots on the ground. You have to have relationships with third-party property management that's very solid, or you have to have it in-house. You're not going to have the economic efficiencies of being able to have somebody on site 100% of the time in a leasing office, or have somebody there that maybe lives on site as a maintenance person. That's just it's too small of an operation to do that. So you have to be crafty in how you go about sourcing and holding on to these. The asset management piece is just different. I would rather, if I was going to invest in Florida, let's say, I would do it as an LP. But if I was going to do it as a general partner, I would want to own something that's 100+ units, because it's easier to manage from Indiana than, let's say, a 40-unit property in Tampa, where I don't have boots on the ground, where it's going to be a little bit less of a sophisticated property management company. The reporting is not going to be as solid. So for those reasons, we feel like we have a niche. We've got the ability to execute in town, locally, and we have relationships with contractors, property managers, all the vendors that you would need to run a property, and we have eyes on the property, which I think is the most important thing.
I think you've touched on the base there, where it's usually as I haven't invested in any deals as of yet, but as a GP, I understand the concepts that pertain to being a passive investor. And you, as a passive investor yourself, I want to ask you if you go by this framework, because usually this is what I hear. It's team first, right? You got to make sure that they have some sort of track record and they have proven results, even in the downturns, whatnot. But team, market, you got to make sure the market can suffice the actual deal, and then the third one would be the deal, right? So that's kind of where my mind's at in regards to like investing passively for that stuff. So I think yours is very niched to the point where you're looking at mid-sized, deep value add, local to your backyard. One of the questions I do have is, if you can disclose this, what's the average return per year, or average IRR, if I may, within the time frame of your cycle or project.
Sure. Well, IRR is definitely not one of my favorite metrics because it's so easily manipulated.
It is.
It takes into account the timing of cash flows, the time value of money. And
Correct.
so if on a pro forma you decide that your numbers don't look good and you had a 5-year hold in there and you change it to a 4-year hold, well, your numbers are probably going to pop a little bit up. So we don't look too closely at that. We look at cash flow day one. And in a lot of cases on these distressed assets, it may be a little skinny, but it is supporting the debt. It is supporting the operation. And then we can infuse our CapEx, and by 12 months, we're able to get that property stabilized, and then we have really solid cash flow. We're getting anywhere between 10 to 18% on some of these deals. Now, if we refinance and we take out our initial capital, that number can drop down into the 8-10%. But we like to leave a lot of margin of safety no matter what we do, and for that reason, IRR shoots through the roof. If you can return investor capital. We did a project in Evansville, Indiana last year. It was a 40-unit property. We bought it for just over $1 million. We put in roughly $200,000 or so. It appraised for $1.7 million. So we were able to get all of the initial capital that was invested out of the deal. And at that point, your cash-on-cash returns are infinite. Depending on the hold period, the IRR will be huge. So it's just a matter of, when do you actually sell? That's when you realize IRR. I think IRR on a pro forma is a nice thing to look at. It's, I guess, a necessary metric, but it really doesn't get me too excited until we actually go to sell, which we prefer not to, honestly. If we can hold the property long term and return investor capital, then that's a much better scenario, in my opinion, than holding something for 18 months and selling it. The days of flipping apartments, I think, are maybe coming to an end.
I cannot agree more. The last guest that I had, we had a great conversation about buy and hold. After his 40-year experience, both as a maintenance man initially to then an actual operator, now a commercial lender. And so what's your take on this buy and hold? Because not only for you as an LP, but also as a GP, I want to get your take on that, because I'm trying to create my investment thesis and I want to incorporate that. But does it actually work? And I'm trying to validate it. That's what I'm trying to do. It's a little hard in these market conditions.
Well, I think, unless you can return a significant portion of capital through a refinance, I think moving forward in this climate, you're likely going to have to, as an LP, get used to longer hold periods, maybe lower return metrics. But if you look at, let's say a 7 or 8% cash on cash, a 13% IRR over the course of the 8-year hold, where else are you going to find that return? I'm not sure where you can find that in today's market. So over the last decade, coming out of the financial crisis of 2008, 2012, there was a lot of opportunities and not as much capital. Now we have the exact opposite problem, which is still compressing cap rates and a lot of competition, liquidity out there looking for a place to go. But if you look past about a decade ago, value add and syndication was just kind of getting started. So now some of these deals have gone through 4 or 5 value add cycles, and there's not enough meat left on the bone, not a lot of meat left on the bone. And the returns are likely going to go down just because we've had such a bullish decade in multifamily. So, with that said, I think buy and hold, if you look at all of the most wealthy people in the world, they have real estate as a component of their portfolio, a lot of times a big component of their portfolio, and they don't sell. And the reason is because there's massive tax advantages. Property value does go up over time. And to me, what is more important is I look at IRR from this standpoint. You can give me a 30 or 40% IRR in a year or 2 years, but what's much more impressive than that is a 12% IRR over 20 years. If you look at the difference between what that creates in wealth and doing it so in a more efficient, less transactions type of way, is where real generational wealth, and you said that before I think we started recording, I think that's really where generational wealth comes from. It's not from flipping properties. It's very tax inefficient to do that. And it works in some cases, and I do it as well. But the real generational wealth comes from buying and holding long term and really never selling.
You hit it on the nail there, and that's probably going to be part of my investment thesis, and to the point where you validated it already, but I just need to find capital partners that are willing, because it's
not been the industry model as of recently.
No, because most of the people that are not only the investors but also the GPs, they just want a quick cash and then get out kind of thing. So that's what I'm seeing, at least. Cool. Thank you very much, Paul Shannon, for being on the show. I really, really appreciate you being here. However, how can people reach out to Paul Shannon?
Yeah, Yvonne, it's been a pleasure. Thank you for having me on today. I really appreciate it. Best ways to catch me are either on LinkedIn, you can catch me there on my handle, or my website is www.redhawkinvesting.com.
redhawkinvesting.com. Perfect. I'll post it on the description box and just so everyone can reach out to you. Thank you very
All right.
much, Paul Shannon. I hope you have an amazing day. I'll end the
Same to you, Yvonne.
recording